And now to help us break down the recent retail sales numbers for November and new numbers for October as well, we're joined by Pedro Antunes. He's chief economist at the Conference Board of Canada. Pedro, you know what the numbers are. They're across the board weaker than expected in November, with or without automobiles included. In October, with or without automobiles included, the numbers have been revised down. What's this telling us about the state of the Canadian consumer and the state of the Canadian economy?
Yeah, well, I think it's the kind of continuation of that story of consumers really being hard hit. Interest rates are having the intended effect. And in fact, this is from a Bank of Canada perspective. Certainly the policy of higher interest rates is meant to slow consumer spending to allow us, essentially supply to catch up with demand and to ease inflationary pressures. So I think we're continuing on that track. What's I think important to note here is that if you look at consumer spending on a per capita basis, on a per person basis, it really is getting hammered. We're in very deep recession territories, and what's masking those that weakness is really the strength in population gains overall. So there's, I think, a lot of pain here being felt by a lot of households, and it's showing up in these numbers.
Pedro, it's John O'Connell at Davis Ray. First, congratulations on being brave enough to call it for what it is. And we've been saying that Canada's in a deep recession for quite some time. When do you think, the Bank of Canada is trying to walk a fine line here, obviously, between inflation and the Canadian consumer, which is hugely indebted compared to the Americans. When does the Bank of Canada throw the Canadian dollar under the bus and start cutting interest rates?
Well, I think we're already hearing from a U.S. perspective that they're planning on lowering interest rates. How should I say? The central bankers there going forward with a lot more confidence here that they've killed the inflation beast. Let me put it that way. Whereas in Canada, we're being much more prudent. So I do think we may, in fact, see interest rates come down in the U.S. ahead of those in Canada. And that means that the Canadian dollar should hold up fairly well if that is the case. But yeah, we're essentially calling for interest rates to come down the second half of this year. So perhaps late spring, early summer. But a lot of that will depend very much on where the inflation numbers continue to head. And I think, inflation has been heading in the right direction. I know it was a little sticky in the December data. But I think what is going to concern the bank the most here now is whether wages start to show some easing, because wages are still running well ahead of something that is consistent with a 2% inflation target. So I think that's what the bank is going to be watching for the most. But certainly our call is that we continue to see the economy heading in inflationary pressures heading in the right direction.
Certainly, Pedro, I would agree that inflation is going to trend lower over time. And when the Bank of Canada is looking at this inflationary pressures, and part of it is interest rate costs, is part of the problem in terms of the way they calculate inflation. How do you think the bank ultimately reconciles this? I mean, we're going to start to see extreme pain in the residential real estate market in Canada if we don't make adjustments here fairly soon. The bank's partly responsible for this, and it's showing up in the inflationary numbers.
Yeah, I think, certainly you can be a little critical of the bank's policy in 2020, 2021 with essentially interest rates at rock bottom levels. It allowed for an awful lot of indebtedness, households taking up a massive amount of mortgage debt and throwing savings that they had accumulated during the pandemic as well at the real estate market. And that really is what drove up prices. And of course, that's an asset, kind of an asset bubble and not really affecting inflation. And the Bank of Canada kind of generally ignored that. Going forward, though, of course, we have seen home prices now react to the higher interest rate environment, to the lower demand for housing, and that is certainly heading in the right direction. But you're absolutely right that what affects the inflationary numbers, it's not necessarily the price of the home, but it's the cost of owning that home, the mortgage costs. And I think the bank is very aware of the impact that higher mortgage rates are having on that bucket of inflation. And let's not forget that rents and more home ownership costs account for about 30% of the basket of CPI. So you're right. I think the good news there is that as we start to see interest rates slacken off, that is going to take away from inflationary pressures. And certainly folks at the Bank of Canada, I'm sure, are very aware of that. They're doing all the math around that. They're just waiting for the right moment that they feel confident that inflationary expectations are down far enough that they'll start to ease up on that.
We only have about a minute left, Pedro. The Conference Board of Canada, and you would have been very much involved in this, has released its latest outlook on the Canadian economy. Tell us some of the other, and you've just finished speaking in some detail about what you see ahead for the Canadian economy. Tell us what else is in that latest outlook, and where viewers might be able to get access to that report.
Yeah, well, I mean, the report will be on our website, and there'll be some briefings and some information that is available to the public on the website. I guess the big stories are the consumer stories. In fact, what we were talking about today, the flatness in consumer spending, and I think the other, of course, big story is that the global economy is feeling very much the same pinch that we're seeing here in Canada. So a weak global environment doesn't bode well for our trade sector. So we're expecting very weak growth overall in Canada for 2024 for this year. If I might just finish on the good news, and the good news is that most of that pain, most of that impact has already been felt, and we're hopeful that we will see the economy starting to pick up, especially in the second half of this year as interest rates come down.
Pedro, thank you.